My name is Vikram Singh Mehta. I'm the chairman of Brookings' most recent outpost, international outpost, the one in India. And I'm grateful to Salman and Brookings Doha for having invited me. We have had some really interesting addresses earlier this morning. All of the various issues that are confronting us in the international petroleum and energy market have been identified. Sitting from where I sit in India, I can see the countries like India no doubt face the fundamentals of supply, demand, and politics, but they also have to worry about, let's say, the non-fundamentals of domestic politics, costs, exchange rates, the speculative trade that impacts the market. Domestic politics, of course, is crucial. I mean, a politician that is dependent on an electoral constituency of 500,000 people to 1 million people has to worry about how to resolve the dilemma between, on one hand, providing secure and affordable energy supplies to his constituents, and on the other hand, incentivizing the harnessing of indigenous hydrocarbon or energy resources, and also keeping within the bounds of fiscal prudence. Now, these dilemmas are not easy to resolve, but over the past 6 months, certainly in India, they have been made much easier to handle because of the collapse in oil prices. India imports 4 million barrels of oil a day, and its import bill last year was $145 billion. That's been cut back considerably, and I'm told that over the next fiscal year, our import bill may be cut in half. So countries like India do have now a breathing space. But that's not just India. China also, and other countries like Japan, we have heard. These are countries that have received a bonanza. On the other hand, of course, there are countries like Russia, Venezuela, and many in the Middle East, which are going to face the consequences of lower oil prices. So many questions are now being asked as to how this particular development is going to impact the market. Will it exacerbate, for example, regional conflicts in this area? Or will it, I mean, this seems a very far-fetched thought, but will it bring together countries like Russia, Iran, and Saudi Arabia around a table to hammer out a production deal to keep prices from collapsing totally? How will China, which is increasingly dependent on oil imports, protect its security of supplies? What is its strategy behind what they call the new Silk Route? Is the U.S. going to be more involved? Now, there are many questions that get raised, and I have a list of them, but I'm not going to try and answer them myself because there is a panel here which is extraordinarily experienced, and they're going to dive deep into all of these issues, and many of which were touched on by our previous speakers. I'm going to request the panelists to spend 5 minutes each on introducing their subject, and then I'm going to maybe pose a few questions that arise as a result of their initial address, and then hopefully we can get all of you engaged in an interactive session with them. I'm going to start with my colleague Charlie Ebinger, who is a senior fellow at Brookings, the senior fellow for Energy Security and Climate Initiative. Most of you know him, so I'm not going to go into a long brief on his CV. But Charlie is going to take us through, on the global oil markets. And perhaps, Charlie, 5 minutes from you, and then we'll pick up from there.
Thank you, Vikram. I think Amos Hochstein set my talk up brilliantly by showing us the dangers of forecasting. Nonetheless, I'm going to try to highlight some issues both from the energy demand and the energy supply situation currently confronting the world, and hope to add some credence to where I think oil prices is going, which for those of you who are producers will be a somewhat sobering assessment, although with great humility I'll be the first to say I may be dead wrong. And just to put that in context, one of the great forecasters, Ruchir Sharma, I love his quote. He said, "The old rule of forecasting was to make as many forecasts as possible and publicize the ones, of course, that you got right. The new rule is to forecast so far into the future, no one will know that you got it wrong." But I do think the energy market is a bit sobering for those that certainly would like to see higher prices. I think the reality is that global demand is extremely weak, whether we're talking about Western Europe, where something like natural gas is projected to be flat, demand is projected to be flat for a decade. Despite the quantitative easing that Mr. Draghi has started, people are already forecasting, when the program is hardly underway, that even after they expend a trillion euros, is projected that Europe may still have an unemployment rate hovering around 10%. Japan, despite some movement forward and a little bit of signs of growth, deflationary worries remain very much on the political agenda there. The U.S., CERA and other leading consultancies have projected that petroleum demand, at least, may have peaked, never to go to levels that we saw in the past, despite our continued voracious appetite for automobiles. China seems to be in a downward cycle of growth, recently cutting from 7.5 to 7, but I know many of my colleagues who are China experts think that even a 7% growth rate for China is probably going to be optimistic when the figures come in, and we'll probably see 6.6 or 6.7. So on the consumption side, things are not good. If we look at the giant emerging markets, Brazil is in crisis. I mentioned China. India shows some sign of growth, but keep in mind that in a number of Asian countries, India being a prominent example, the slashing of subsidies, which has led to excessive demand because of the low prices. Subsidies are being eroded in India and Indonesia and China, Thailand, Pakistan, and a host of other countries. That's going to have a negative effect on demand. We also see the fact that it's not mentioned very much because it's still far in the future, but when President Obama's new fuel economy standards that he put in his first administration ripple through the system, it's estimated will drop oil demand by another 1.8 million barrels a day. That takes the better part of a decade to come through, but it's no growth really seen there in the United States. And indicators like the Baltic Dry Cargo Index, which measures the bulk commodities moving in the world, hit their lowest level in mid-February in literally years. And we also see the fact that once again, it looks like the hedge fund people are getting it wrong. We have 500,000 bets by the hedge fund managers that they're going long in the market, suggesting they believe they're going to be higher prices, and it was largely because they got it wrong on the downside that we saw the cascading prices. Let me just quickly turn to the supply side. Excuse me. We've had several speakers note that global inventories are at record high. The Chinese are building a strategic petroleum reserve. Commercial stocks in the United States are huge. When these stocks are eventually drawn down, it can't be good for anyone that thinks we're going to see an upward drift in prices. An Iran deal, if one were to occur, is believed, estimates are all over the roadmap, but probably relatively quickly see another 500,000 barrels a day put onto the market. We've got the reality that 3.5 million barrels a day of oil that could be produced is not being produced because of various political conflicts, whether you're talking about Libya, we've heard about, or South Sudan, or Yemen, Venezuela, the list goes on and on. But imagine if any of that 3.5 million barrels a day, and any sizable numbers, even a third of it, were to come back on this already saturated market, it would not be a good story. We also believe that non-OPEC supply, the IEA and others are still suggesting that we're going to see somewhere around 800,000 barrels of new supply come in from non-OPEC countries in the course of calendar 15. although it's not looked at very often, if you look at the whole growth of biofuels in the world demand supply picture today, there's 4 million barrels now a day of biofuels in the international market. We've got the uncertainty of what happens if Japan either does or does not start their nuclear reactors, that we heard a very impassioned presentation earlier this morning. But clearly, if Japan were to start up a sizable number of their reactors, the demand for LNG would be deeply impacted. So when I put this all together, I see very little reason to believe there's any upside potential in the near future. Very little reason to believe the bulls who think we'll at least be back in the 50s or 60s on average by the end of the year. I think it's very likely that we will see the low 30s, even the high 20s, before we see $60 again. Thank you.
Well, thanks, Charlie. Thank you first for keeping within the 5 minutes, and secondly for being so bold as to actually put a number to your prediction. Next year, this time, I hope someone is going to be able to take you up on that. And but may I request His Excellency Adnan Al-Danabi to give his remarks. His Excellency was the chairman of the Oil and Energy Committee is the chairman, sorry, of the Oil and Energy Committee of the Iraqi Parliament. He's had a very distinguished career, which goes from involvement with the IMF and the World Bank, the National Oil Company of Iraq. He was also a director of foreign relations in the Ministry of Oil. And as a member of parliament in 2005 and 2006, he was the chairman of the Finance Committee. And he was also vice chairman of Iraq's constitution, the drafting committee of the constitution. So we do have an extraordinarily experienced person on our panel, and I'm delighted and honored to welcome you. And could you kindly
Thank you, Mr. Chairman, for the kind introduction. I'm glad to be here for the second time in Brookings, Doha. I will try to compress what I'm trying to tell you in 5 minutes. I don't know if it's feasible or not. I'm not going to make any predictions, so I'm not in danger of being proved wrong in the process. In the last few years of this decade, we have seen 3 huge events, revolutions, whatever you want to call them, impacting the geopolitics of energy and the area. Starting with the American shale oil and tight oil and shale gas revolution. We've heard about the importance of that from almost everybody and every meeting I've been to, but we have not come to consensus as where this is going to lead us. The second global event, at least affecting the MENA region, is the Arab Spring and its ramifications. We are still in the middle of the chaos which was created by some of the changes and conflicts arising from the so-called Arab Spring. And it's going to affect the area seriously. We are seeing what's happening in Yemen. I don't think the rest of the area is immune. We've seen what happened in Syria and more recently in Iraq. So the ramifications of the chaos created by the events after the so-called Arab Spring have not yet unfolded completely. The third thing which we're seeing more recently is the drastic decline in oil prices and its impact on the whole energy geopolitics, whether globally and everywhere, affecting not only oil and gas, but also the whole of the energy approach of every country in the world. Unfortunately, we have not developed the necessary institutions to handle such huge changes. We have OPEC, an organization of so-called exporting countries, yet 2 of the most important producing countries America and Russia are not included. And we have the International Energy Agency, which is supposed to be an organization of consumers, but not including two of the most important consumers now, China and India and some others. We were looking forward to see what could come out of the Energy Forum in Riyadh, and I think we still need that institution to come up with some ideas as to how to handle the chaos we are in. Price changes, which were in 1980s, were considered very drastic, especially the rise into the 30s and 40s and decline into $8, $10. And then in 2008, we had prices rising to $140 and then collapsing to somewhere near $30. And in a few years, in half a decade, we are seeing another cataclysmic change in energy prices. And the lack of institutional capability to handle these huge and drastic changes in international trade, accounting for trillions of dollars for everybody, is unacceptable as a policy and unacceptable for the stability of future energy requirements internationally. So really, we need an approach of serious cooperation between producers and consumers, and with Lu'ay al-Khatib here in front of me, who's more recently joined Brookings. Before he joined, we published a paper on the need for cooperation, and we referred to what happened after the Second World War in this restructuring of the international world institutions, from the United Nations to the various institutions, World Bank, International Monetary Fund, and other institutions. Unfortunately, what was advocated at the time by Keynes, who is known for his theory about full employment, but probably many people forget that he advocated the need for stability in commodity prices by developing a world energy institution. We had the UNCTAD, which couldn't and didn't engage into institutional cooperation on commodity markets. And then we had the World Trade Organization, which is yet not fully empowered to handle such events. And we have a unique problem with oil and gas, which is the gestation period between knowing that reserves exist and the ability to bring them out. The International Energy Agency came up with strategic reserves, but they have not been useful in, except in very minor events, to handle fluctuations in prices. I think we are now, should be, ready to talk about, and I hope the Brookings Institution will take this up, to talk about the need for cooperation between producers and consumers, and the need to have new institutional structures to take over from the institutions which we have already, which were incapable of handling crises like the ones we are dealing with. Thank you.
Well, thank you. That was very specific and very, very interesting. I have a couple of questions on that, if I may come back to you at the end of this round of conversation. So let me now turn to David Hobbs, who's the head of research of the King Abdullah Petroleum Studies and Research Center. And he was the chief energy strategist and head of research at CERA, the Cambridge Energy Research Associate, and is well-known expert in the energy industry. David is also an adjunct professor at the University of Calgary, and he's on the management board of the Global Energy Executive MBA program. So David, I'm not going to ask you at this point to talk about Saudi Arabia. I might come back to it, but I just would like your overview of how you see the market and what are the sort of main trends that you'd like to highlight at this point.
Thanks, Vikram. The first thing, I just want to be very clear that oil is not the only energy. I know it comes as a surprise to all by the Qataris in the room who realize that gas is the only energy. But actually the fastest growing source of energy and the one that's probably showing the most volatility is coal. So we have to think about what's going on in terms of trade flows in all three of the major fossil fuels if we're really going to tell a geopolitical story. Enough has been said about oil and gas, but just on coal, of course, the big swing. China is the world's largest importer of coal right now. It has been, in the not distant past, the largest exporter of coal in the world, and all of that swing was the result of about a 3% rebalancing of supply and demand. You can imagine that the difference between two very large numbers provides a gearing effect. A lot of relationships will be made and lost as a result of whether China ceases to be an importer. It's declining in terms of the size of its imports, and that makes a difference to who its friends are and who its perceived competitors are. Of course, India is setting out on a path. The Prime Minister has just said that he wants to see what amounts to 18% annual growth for the next 10 years in coal production. That's against single-digit growth in coal production in recent years. But the consequences of that is that India would potentially end up consuming about the same amount of coal as China does today, 20 to 25 years down the line. That's certainly going to ruffle a few feathers, given that it seems when people are bemoaning the lack of demand for oil and the lack of demand for gas, or if you like, the flattening of growth, that's the deliberate policy of OECD governments. I mean, it's being executed differently in different places. In the United States, it's through efficiency and increased energy productivity. In Europe, it's through preventing economic growth. The two tracks both achieve the same ultimate result. I know which one I would rather be living under. We then sort of discover that actually 17-year-old boys have got a greater insight into what's going on than most policymakers. My son certainly discovered you can't inform your girlfriend of your intention to break up with her and expect that that piece of business will happen somewhere down the line. It happens at the moment that you speculate about your ambition. And so there's a terribly contorted dance going on in the OECD with people saying, of course we love and want you to continue investing in the fossil fuel resources that we're going to need because the transition is going to take an awfully long time, in the hope that they don't get the hint that in the end there's a breakup in the future. And when there's a breakup in the future and the demand is going down, the price of the commodity tends to be at the marginal cost of production or nearer the marginal cost of production than the full cycle cost of supply, because you're not having to invest in the full cost of supply. We've got this difficulty of really, we're trying to talk about cooperating and eliminating volatility in a relationship in which we really don't want the same things. That brings us to the difference, if you like, between security and reliability. And don't forget, when Winston Churchill talked about variety and diversity, Britain had a pretty dominant navy that could go and beat up anyone that didn't supply what they wanted. That was, if you like, the paradigm of Churchillian variety. Today, we've got diplomatic norms that don't allow us to go and beat up people, except in extreme circumstances where apparently we still do. It requires, if you like, Churchill plus as the new paradigm for energy security, which is deep friendships that eliminate some of the frictional costs of trying to secure your energy resources from people that you know don't like you. Because let's face it, that's why we overinvest in a lot of things to protect ourselves against people that we're worried might not be our friends in the long run. And that's different than reliability. And in reliability terms, I think we also have to begin differentiating between swing producer and holder of spare capacity, because they are subtly different things, and they have different consequences in terms of relationships between nations. I love the idea of let's all talk and find a happy place where we can eliminate volatility. But I guarantee if I were to do a survey of people in this room and say you have a choice between volatility or having prices sat at a level, if you could even agree what the right level is, for long enough that we store up a real crisis, and that the future of the next 20 years is to have 4 major crises and the total reallocation of resources that results from that, or to have volatility and the freer markets where the price signals send us indications of how we ought to be investing. My guess is that 20 years from now, and Charlie, I hope you'll still be around. I'm certainly not sure I can afford to still be around given the state of my pension provision, but nonetheless, we can talk about which of the two we would have preferred at that point. And so what seems to be going on right now is that we are administering one of these slaps that the market has to receive to remember that prices won't always be high, just as there's a slap from the market when we start believing that prices will always be low. My prediction, and I'm absolutely confident in this one, is that prices will be higher and then they'll be lower, but not necessarily in that order.
Oh, great. Okay, well, we're getting someplace here, higher, lower, not necessarily in that order. Charlie, you might want to respond to that at some point. Excuse me, Andy, excuse my pronunciation here, Konoplanic, yeah?
Yes, it's me.
Yeah, right. Okay, great, thanks.
You can call me just Andre, it will be easier.
You're an energy economist by background.
To pronounce, you can call me Mr. Hempfield. It's just the same.
Why don't you help us and tell us the correct pronunciation?
Okay, Konoplanic.
Yeah, all right, great.
Very easy.
All right, sorry, but anyway, you're an energy economist by background, currently an honorary fellow at the Center for Energy, Petroleum and Mineral Law and Policy at the University of Dundee in Scotland. And Andy has had a lot of experience with Russia. He's on the editorial boards of various Russian journals, Neft Rossi. He's published more than 500 articles on energy issues in the USSR and Russia and abroad. And I'm told by him that he does not want to at this point speak about Russia, but he does want to actually touch on the global market with the focus on energy economics. But in our discussion, we may come back to Russia. Andy.
Okay, fine. Thank you so much. Strictly 5 minutes, so time control. Thank you for inviting me here. It's not the first time I am here, so people got used that I will be speaking quickly. I was a little bit surprised as today I'm presented as my affiliation, University of Dundee. I'm just a visiting lecturer there. My major affiliation, I am advisor to Director General of Gazprom Export for last 2 years, and a half-time professor in Brookings State Old University, but that doesn't matter. I always speak as Konoplanic. So I would like to address some issues that we already raised here, and that was raised in the Brookings papers that we have received here. The topic was the development in global energy markets and the impact on the price of oil. And there were 2 schools of thought here: conspiracy theory, which is the radical version of the geopolitics, or economic cycle. I'm an energy economist. I'm a project financier. So definitely I consider that geopolitics just make economic cycle either more volatile or less volatile, but we're living in the world of economic cycles. And today what we saw behind the oil price decline in 2014, from my point of view, is just another wave of this same cyclic development. One of the previous waves we saw in 1986, when the oil price collapsed to $8 per barrel, and definitely at that time, it was also a debate whether it was a combination of the conspiracy theory, secret agreement between Saudi Arabia and Mr. Kissinger's shuttle diplomacy aimed at destroyer of USSR, or it was just the result of high oil prices in the 70s that stipulate the investment cycle, and then the balance of demand and supply has changed. From my point of view, we're facing today the same result. Increase in production, slowdown of demand, 5 years of high oil prices in the oil market stipulated then the overproduction, and the oil prices were coming down. But the point here, from my point of view, a very important one, and I definitely would like to repeat that term that was used by Mr. Al-Janabi, US shale revolution. I definitely think that here is the important objective US role, non-dependent that some representative of this nice country were badly criticizing my country in their opening remarks, which I disagree with. I speak about, Mr. Ndik, your comments when you are saying Russia aggression or our intervention to Ukraine. It's the civil war in Ukraine. We have different views, but that's a side of the story. I think the role of the United States definitely has a very important effect on both gas market and shale market. But again, we're living in the world of long cycles. From my perspective, the beginning, the birth of this shale gas revolution in the United States come as far back as to 1977, when the program Energy Independence was first announced, and after that, US government for almost 15 maybe years, even not more, were investing state money into research and development in different areas, and then the role of personality, Mr. George Mitchell, who was spending 15 years trying to bring together well-known technologies, the 3D seismic, horizontal drilling, and multiple fracking to make this technology commercial, and then finally, after 30 years, in 2007, we see the rocket style of increasing US shale gas production, which has its domino effect on the global world. Not in terms of repetition or potential repetition of this US shale gas revolution elsewhere in the world. My firm conviction, it cannot be repeated anywhere with this space, with this volume as United States. There is no other US economy elsewhere in the world. And the reasons for this US shale gas revolution were not the resource base, but above the ground arguments, above the ground factors. So it cannot be repeated. No in China, no in Argentina, no in my country, no elsewhere. But it has huge institutional effects. We're sitting here in the host country, Qatar, and we do know that when US market has closed for imported gas, Qatari LNG, which was already in the Atlantic basin, was just redirected to European Union. It creates the oversupply inside the European Union because it was combined with the slowdown of economic growth in the result of economic crisis. And this oversupply, first of all, stipulates the liberalization trends, third energy package, and its implementation in European Union. And this oversupply forced the companies that were major suppliers to European Union gas market, like my countries, my company, Gazprom, Norwegian Statoils, Algeria Sonatrach, to become adaptable, to become strongly, as quickly as it was possible. The bigger the company, the more slow it's in adaptation. That's quite normal. But it was an obligation, forced movement, forced push to adapt to the changing realities of the market. So that's one, from my point of view, the key domino effects of US shale gas revolution, and we can mention a lot of them, like redirection of the manufacturing industries back from developing countries to United States, like the changing competitive game inside the US market between the gas and coal, and so coal went, then exported US coal went to European Union market, a lot of this. Another reason for this, another consequences was that the prices of gas going down, the development of dry gas deposits became sub-economic or non-economic, so the shift was moved either to development of the rich shale gas or to the shale oil. So that's created, let me say, the shale oil boom, the shale oil US revolution. And here, from my point of view, the key question that I am presenting to the audience is the following. We do understand, I'm the project financier. We do understand that all these developments, because in order to develop shale oil or shale gas, you need to heavily invest. It's project financing, it's debt financing. The liberal financial market of the United States provided huge opportunities to hedge these financial risks, to financial debt and everything. Expectation was that sometime post-2015, when the LNG export from the US will start, when the third tranche of Panama Channel will be opened, ready for LNG carriers to pass through to go to the Asia Pacific, the premium Asian market with the high oil price linked through the GCC to the LNG market, so high gas price will provide an opportunity to cover these financial debts, this financial bubble that existed in the oil and gas shale producing economy in the United States. And this bubble will be softly going down. Now my question to the audience, the second one. The first one, how this bubble will work, how the debt situation, the accumulated indebtedness in oil and gas producing companies in the United States will further be developed. How it can be possible now to deal with this issue under the environment of the low oil prices and low LNG prices in Asia Pacific. What domino effects we will face here? And I think I need to stop here because it's already 7 minutes, but if you give me 1 more minute, I will shortly touch 2 more issues. Thank you. So that were some of the aspects of the low oil prices. Now I will come to something that I will finish with the word cooperation. What will have direct impact on my country, for instance, the low oil price environment? We have different political visions, and I know that my country today is under sanctions, both from the United States and from European Union. And that's stopped to develop Arctic offshore. And our Chinese friends taught us that each crisis has 2 dimensions. It's the problems for existing trend of development, but it's the challenge for new developments. So from my perspective, I will not speak about negative consequences of the sanctions. I see 1 positive consequences of the sanctions. It's slowed down Arctic deep offshore development. Because today, that's my vision, my understanding, no country in this world, no company in this world is ready to economically profitable and ecologically safe develop deep Arctic offshore. So I hope that when the sanctions will be lifted, not against Iran, but against my country, that will be a new start for cooperation between the countries and the companies to jointly develop Arctic offshore as it was in the 70s, in the middle of the Cold War, when 2 countries, USSR and the United States, were competing with each other in the development of the outer space, but then they understood that cooperation is much better. And then we face Soyuz Apollon and so on and so forth. So I do see that this influence, negative, short-term influence of the sanctions, of the low oil price on the deep offshore Arctic development, after the sanctions will be lifted, will bring us to the new level of cooperation to the mutual benefit of all the countries involved. Thank you. That's were my initial comments.
Thank you, Andy. Thank you very much. Some of the problems that you've just described about shale certainly apply to India as well. We face above-ground problems much more so than below-the-ground issues. Our last panelist in the opening round, Victor Gao from China. Victor, I would request you to try and bring it down now to a single country issue, China.
Thank you very much. It's a great pleasure, great honor to be here back in Doha, and I thank you for having me. Excellencies and ladies and gentlemen, before I start, please allow me to express condolences to those families and friends who lost their loved ones in that German airplane crash in the French Alps. It's at times like this they are reminded how fragile life is and how much a premium we need to pay to peace, stability, and possibly including energy security. Our senses of energy security, whether they are very solid or very shifting or very false, it depends on which view you are taking. And I would say if you look around in today's world, in the energy sector, especially in the oil and gas sector, there are many uncertainties. And on top of that, there are uncertainties about uncertainties. But allow me to emphasize 1 point. There is one big certainty, that is China's continued and increased demand for imported oil and imported gas for many years and possibly decades to come. Therefore, if you are worried about whether you can line up a long-term supplier for the extra oil or gas you may develop, if you are worried about whether you can line up a long-term financier to provide money to help you to pay for the capex, to build up the big upstream projects, if you are worried about whether you can find someone to help you cut down the cost in building up these capacities, or whether you are worried if you can find up someone to help you build up your pipelines, gas or oil, or other oil and gas infrastructure projects on a timely basis, talk to me or talk to our other Chinese colleagues in the audience. China may be able to help. And talking about the oil price, many people think it's a net gain for China, but allow me to say one thing. It's actually a bittersweet proposition as far as China is concerned. On the sweet side, each $1 drop in the oil price will generate a net saving of $2.1 billion US. So if we are talking about, on an annualized basis, a $50 US dollar drop in oil price, you are talking about a net saving of around 105 billion US dollars. That's quite some pocket money for any country we are talking about. But on the bitter side, much of China's imported crude oil actually comes from the equity share oil that the Chinese money has been investing overseas over the past decade or so. So you are talking about, that income for the investors on the Chinese side shrinking significantly. And also, China has been probably making the largest amount of investments in the upstream oil and gas projects abroad over the past 10 years. Now, with the drop in the oil price, much of these investments accumulated over the past few years are now out of money. Of course, the Chinese investments are aimed for the long term, and they do not care much about day-to-day fluctuations in the oil price. But whether this significant decline and making the large Chinese investments in upstream oil and gas assets abroad would put a damp on the Chinese eagerness to make huge investments abroad, to engage in large M&A deals, etc., that's another issue we need to pay attention to. Now, I would say that we have to be philosophical about the oil price. I agree with the other panelists. No one can predict accurately the price of oil on a consistent basis. If you cannot control the oil price, you have to go along with it. That's the philosophy in China. And I think, more importantly than guessing about the price movement, securing availability of oil is more important than guessing at the price of oil. That's why China has spent a lot of money and efforts, and in my judgment, has become the biggest country in building up crude oil and the gas pipeline infrastructures over the past few years. And ironically, China's strength, as well as fragility, as far as oil is concerned, is that it has the largest demand for oil in the foreseeable future. Therefore, oil, in our view, is long-term. The short-term volatility of oil price will be balanced off by the long-term supply and demand considerations from a major market, major buyer like China. And in our view, oil should be a commodity rather than a geopolitical or ideological weapon. But the concern is that in today's world, it's increasingly becoming an ideological or geopolitical weapon. Let me finish by saying a couple of things about the One Belt, One Road, and the Asian Infrastructure Investment Bank. Now, I would say my best judgment, it is the first time in human history that any country is looking at the whole Eurasian continent as a whole and propose a growth or development paradigm based the whole Eurasian continent. This will generate huge impact, not only for a country like China, which is proposing that, but for many other countries along the One Belt, One Road. By Chinese calculation, there are more than 60 countries along the One Belt, One Road. One Belt refers to the Silk Road economic belt, which is a continental belt, and the One Road is the 21st century maritime Silk Road, which is a maritime route from China all the way to the Middle East and possibly to the Horn of Africa. And I would say that anyone who joins this initiative will generate growth possibility for all the countries involved, and anyone who wants to shut himself out of that probably will do so to his own detriment. Now, of relevance to this discussion and this audience is that it's time for us to consider what are the energy considerations of this major initiative of One Belt and One Road, because part of the infrastructure investments will definitely be in the energy sector, including pipelines, terminals, all the facilities, connectivities, etc. So I would say that whatever strategy you already have for your oil and gas considerations may actually be benefited if you start to rethink about your energy supply, energy sale on the demand side or supply side in light of this new initiative. Now, on the AIIB, the Asian Infrastructure Investment Bank, it's very encouraging, despite of the efforts made by the United States. More than 35 countries will sign up. You know, major European countries like the Great Britain, Germany, Italy, France, Austria, Luxembourg, Switzerland, you name it. They are all committed to sign up. And I would say that it's very likely that before the deadline runs out on March the 31st, countries like Canada and Australia and South Korea will join. For the moment, it seems that both the United States and Japan will not join. It's not because China refuses to allow them in. It's because they decide not to join. So don't accuse China for not being open-minded, for not being all embracive to all the countries. But I would say that if Japan remains out of AIIB, it probably will be cut out from the great excitement that will be generated in this One Belt, One Road initiative. It's very, very fortunate and encouraging that great countries like Saudi Arabia, Qatar, and Kuwait, etc., are all joining, and I hope more countries in the Middle East to join, the better. And I would say, in terms of investment in infrastructure, in connectivity, the more, the better. The more, the merrier. Because with improved infrastructure and connectivity, we are talking about greater possibility of improving productivity for all the countries involved. And I know 5 minutes is very short. I've prepared a speech, probably will take about 30 minutes to make. And if anyone is interested in that, talk to Brookings, Doha, and they will give you a copy. Thank you very much.
Thank you. Thank you very much, Victor. Actually, just picking up from what Victor said, His Excellency, Your Excellency, could you, I know that China has a very substantive investment in Iraq. A very large part of its equity oil is coming from Iraq. Over and above the economic sort of issues, could you, are there any strategic or social ramifications of China's deep involvement in Iraq? Are there any concerns that you have about this particular involvement? I mean, it's a question that actually could be asked of other countries in the Middle East, because Middle East is China's largest trading partner.
Thank you. I don't think Iraq has any problems with having organic, more integrated relationships with their main markets. And although I myself am very critical of the lack of strategic marketing policy in Iraq, we need to develop that into a clearer marketing strategy, working with China, with India, and with other major consuming countries. I'm a very old person. Back in 1968, I went to India, Pakistan, and Ceylon to discuss integration of our potential exports with the markets, and I discussed with the Indians the possibility of a joint refinery in Madras, and with the Pakistanis on a joint refinery in Karachi, but unfortunately the upheavals which came later put a stay to that. I think we need to develop greater integration and cooperation, more organic with our consumers and with our importers, especially China.
David, I just want to turn to you, because this issue of China and India, and the fact that you might say the pivot of the oil exporters is now shifting more and more towards Asia as China and India become the major importing countries. His Excellency has talked about collaboration. So my question is, what do you think are the chances of a sort of a monopolistic consumer alliance that, rather than a producer-consumer alliance, but one just one centered around major consumers coming together to ensure that they might have a much stronger bargaining leverage with the producer countries?
It's interesting you mentioned that. It's been talked about fairly extensively by the four major importing economies in Northeast Asia, for sure. And the central sticking point seems to be who's going to lead it. All four have made proposals to the other three, and each of those proposals is intrinsically sensible in terms of creating a greater market power for a consumer. There's a desire to have some kind of trading hub in the region, again, in order not to have to rely upon benchmarks, whether it's in Brent or it's WTI or whatever else. But until there is less ego involved, I think it's unlikely to happen. But also, you need to have a greater alignment of how you actually view the markets. This point about conspiracy theories are really hard to sustain for the long term unless it's only one person involved, and when that happens, it's a decision, it's not a conspiracy. Until people actually trust markets, it's very unlikely that you're going to have an open market hub. But all four of the Northeast Asian economies have different suspicions about the market, and until A, they can agree what those suspicions are, and B, they cease to have suspicion about the market, it's very unlikely that that'll happen. But I think there's a different game going on, if I can just say briefly, which is that China is, if you like, the new kid on the block among those, the other three, Korea, Taiwan, and Japan, have established long, deeply mutually interdependent relationships with their Middle Eastern suppliers. China hasn't yet done that. I think the One Belt, One Road initiative is certainly a step in that direction, but how that relationship evolves from what is today a very transactional relationship into a more strategic, mutually dependent relationship, and how that displaces the other three major importing economies to make room for that, I think, is the really interesting geopolitical question, long before we get to a buyer's cartel along the way.
Andy, you had something to say?
Can I add just to this, if I may, because I think you raised a very good question. Definitely, I think we need to have an opportunity to look and to see the forest behind the trees, if I say. So what will be the general trend, I think? In energy market developments, which is one of my specialties, we're definitely moving from the more monopoly to more competition. So in this case, I think, with current development of the markets, which became more disintegrated, more diversified, opportunity for consumer or producer unions, which was definitely the story in the past, which usually the parties were united against some other parties. I think now we are moving to the new world, and that's a slow movement. It's need time and money. I think the world of cartels is definitely, in classical understanding of the cartel, is now being changed by the world of diversified opportunities for producers and consumers to choose freely their counterparts, which means that in this case, what unites the world is the common interests. And the common interest is the minimization of the investment risks. Investment risk, because the driver for this diversified market is definitely energy infrastructure. And energy infrastructure is the most capital intensive, it's fixed, it's immobile, and when you dig the money into the ground, you, for instance, lay the pipeline or the grid, well, you can't, let me say, have an alternative route because that will be stranded assets. So that does mean, from my point of view, that is the common interest for the countries for cooperation to minimize these investment risks. And that does mean that initiative of our Chinese friend, that we're saying that definitely special instruments for providing opportunities for develop energy infrastructure, capital intensive, immobile infrastructure with less risks and costs, from my point of view, is definitely a very clear common way. Moreover, some of the speakers in this audience already, Mr. Hostein, Mr. Lovengrove, Mr. Gao, has been mentioning what Churchill has mentioned in 1911, diversity, as a driver of energy security. But that's energy security not only for importers, security of supply. That's also an opportunity for the exporters to choose between their markets, to choose between their consumers. So again, it's diversity. It's diversity to diminish the transit risks. Here I disagree that bypasses not add to the security. They add to the security, both for the producer and for the consumer. We are just minimizing the transit risk. So from my point of view, this general movement, overall economically justified trend, the long-term capital cycle is something that moves us from the world of cartels against some other parties in the market to the world which will be based on development of the common denominator and expanding this common denominator. I spent 6 years in Brussels last decade in energy secretariat. So I'm addicted, as Mr. Bush was addicted to oil, I'm addicted to the concept that we need to cooperate based on finding the common equilibrium and trying to expand this area. So I think the energy infrastructure, development of energy infrastructure is something that definitely needs to unite the parties, non-dependent, consumer, producer, or transit states.
Victor, you've been reading.
Yeah, thank you. Talking about the importance of energy infrastructure, allow me to use the example of Canada. While I have the greatest admiration for Canada and support Prime Minister Harper's initiative of building Canada into an energy superpower, I'm afraid that Canada missed the trend that the United States wants to become energy independent. Secondly, they placed too much importance or hope on the Keystone Pipeline becoming approved by the United States. It was vetoed by the President Obama recently, and it failed to get its acts together to build up the Pacific Gateway energy infrastructure projects. Now, I'm afraid Canada is caught in a binder because the dependence on the United States side on imported energy from Canada is decreasing, and the United States is standing in the way of allowing Canada to build the pipeline from the Canadian side all the way to the Gulf of Mexico, and it will take years, if not decades, for Canada to build up the Pacific Gateway project, allowing it to move its oil and the gas rather than down to the continental of the United States, but westward to the Pacific coast. If it does move the energy to the west, to the Pacific coast, then countries like Japan, South Korea, China, and China's Taiwan may very much get involved. But if you look at the Canadian dollar, listen to me, it will continue to weaken against the US dollar for the foreseeable future until that country gets its energy initiatives in the right shape. Now, talking about Canada is one thing, but talking about each and every member country of this distinguished group is the point. That is, to get your energy infrastructure into the right shape is the most important thing that you can do for your own country. It's a life or death initiative for the long-term sustainability of the country. That's why I think this One Belt, One Road initiative or this Asian Infrastructure Investment Bank initiative are designed to work together to build up the infrastructure initiatives and infrastructure connectivity, including the energy connectivity. Just imagine when you are caught in a binder like this, when money is drying out and you have half-finished the projects. Each project is very capital intensive, and each project needs connectivity to go to the shores or pipelines to ship the gas or oil to the final destination. You know, the Chinese pipelines already reach all the way to Turkmenistan, and Turkmenistan borders with Iran, and Iran is just one body of water away from Qatar. So you are talking about the pipeline system that China spent billions of dollars doing, and China manages to finish these projects way ahead of any other country could have thought about. The Canadians have been talking about Pacific Gateway for decades, and it's still there. The Keystone Pipeline has been on the drawing board for years, and it's being blocked and being vetoed again and again and again. What a shame. I think we need to get our acts together to really put a premium on building up energy infrastructure and connectivity. That will create a premium on the commodity you have to sell, either gas or natural or crude oil. Thank you.
Thanks. Charlie, just one question, and then I'm going to throw it open to the audience. But you know, if I was the conspiracy theorists have argued, and I'm not saying that I agree with that, but they've argued that one reason why Saudi has sort of not played the role of a swing producer is because they want to hit Iran, and then they want to bring Russia to heel, and so on and so forth. And so there's this conversation that the drop in the price of oil is going to exacerbate regional tension. But there's a wild card possibility that, all countries are going to suffer, and eventually at some point people will be driven by economic logic, and maybe Russia, Iran, and Saudi Arabia will come together to hammer out some sort of a deal that pushes prices back up to something that's acceptable to them. If that happened, firstly, what is the likelihood of that happening? And secondly, what would be the response of the US to such a regional, or you might say more than regional, kind of this sort of an initiative?
It almost has to happen, because I see a major disconnect when we see the numbers about China becoming the biggest importer, Asia in general. Most of the forecasts say Asia is going to be 90% of the growth in world oil demand the next 15 to 20 years. Where I see the disconnect with what Victor is saying, if you don't believe that Iraq is going to stabilize and become an 8, 10, 12 million barrel a day producer, that Iran's going to rejoin the family of nations, let the oil and gas industry in, become a giant producer again, I don't see where the volume of oil comes from to meet Asian demand, particularly if we have even a prolonged period of relatively low prices, so we write off the Arctic. We can't develop the Arctic, and we can't get the Gulf producers to reach their maximum capacity because of politics in the region. I don't see how Asian demand gets met, and particularly Chinese demand. And I don't think it's going to be pipelines, Victor. I mean, I assume you're probably thinking that we're going to build the TAPI line from Turkmenistan down across Pakistan and India. I've worked on that project for 15 years, and believe me, it won't be done by the time I'm long dead in my grave. And the same with the IPI pipeline. I mean, that might be feasible, but every time you talk about it with India, they go ballistic and say, we don't want a pipeline that crosses Pakistan. So and you're talking about dealing with countries like Kazakhstan. I mean, I know China has good relations with a lot of those countries, but they're authoritarian countries. And there's prospect of all of a sudden somebody getting mad at China for being the big bully on the block. I think you shouldn't rule that out. These are not guys that are going to roll over and play dead just because of Chinese strategic interests. So I'm very skeptical that we're going to see this great move. I also think it portends, in getting to your question, it portends the question, if Asia is the one getting all the oil from the Gulf, why is it the United States spending our blood and our treasure to defend the Gulf? At some point, China, India, and others have to ask seriously if they want a blue water navy to at least pick up some kind of shared response. I'm not suggesting the U.S. is going to withdraw, but we shouldn't have to carry the whole load. And I think increasingly there are a lot of people in America, in the heartland, that are questioning that. Maybe not in Washington, maybe not in New York or Boston in the intelligentsia, but there are a lot of Americans that don't want to shed one more blood of one more American to defend Persian Gulf oil and gas.
Okay, well, David wants to I'm going to have to ask some, otherwise I'll definitely be a very unpopular moderator.
It's a two-second intervention. I just want to apologize to all the people from outside the intellectual East Coast that Charlie just wrote off. But the more serious point is that absolutely there is a serious risk, even from Boston liberals, among whom I count myself until recently, is that they're going to find it very difficult to make the case, even though they know emotionally, even though they know intellectually that America can't withdraw. They're going to find it very hard to make that case. And so energy insecurity in the Gulf doesn't actually matter whether it exists. It just matters whether you believe that you no longer care. And that is, I think, an equally large risk to the autocrats of Central Asia saying they don't buy Chinese dominance.
Can I have a short remark to Charles, if I may? Very short.
Very short. Okay. 30 seconds.
Liberals, conservatives, I do not like this. Well, I worked in Gaidar's government. I was considered to be also the liberal. I would like to say something about energy infrastructure. Charles, I think I have a different view. I will not say that I will disagree with you. I think if there is the common interests and financeable rules, it will not take a long time to develop the pipelines. I will give you just one example regarding our Chinese friends sitting here. There was Nabucco pipeline project in the European Union. It was to be developed, it was not developed. It took them 28 months to receive all the permissions, administrative permission to derogate from the rules of the second energy package to be financeable. During these 28 months, our Chinese friends has agreed with Turkmenistan, Uzbekistan, Kazakhstan, has prepared feasibility study, has approved final investment decisions, and had constructed this long-distance pipeline from Turkmenistan through Uzbekistan, through Kazakhstan to China, to Sinzai-Ugursky region, to connect it with the second, I guess, line of the east-west Chinese pipeline. So if the common interests are there and financeable rules, it might be different financeable rules, either administrative order in some countries, or maybe regulatory rules, but common interest plus financeable rules, that does matter. And then the time will not be so long. So I think maybe in these pipelines that you mentioned, either the risks are very high and that's non-conventional. To pass through Afghanistan when it was the civil war there, it was a problem, of course. Or maybe there is not too much common interest, so something prevents to make it quick, as it, for instance, was in the Central Asian case.
Okay, now I've got 10 minutes.
Because there was disagreement on the price
level.
level.
I'm going to ask all of you to ask very brief questions, and because otherwise we definitely will not be able to end on time. So, first, second, and any other hands here? Well, two questions first. Yeah, brief questions, sir.
Yes. Mr. Chairman, thank you very much. Of course, there are two comments, but I'd like to make them very short. First comment is that I'm seeing one more paradigm changing where the wealth generation was directly correlated with the energy consumption. And if you see the pattern from here 2000, the OECD countries, wealth generation continued to increase, energy consumption continued to decrease. Part of it is because the knowledge economy has started kicking in, which needs much less energy. Second, of course, the improvement in the efficiency of use of energy. USA from 1980 to the present time has improved efficiency by 50%. So looking at all those things, I personally feel that the OECD countries' projected demand, projected increase in GDP is way too steep compared with the energy not only leveling off but declining. Therefore, you have to factor that thing into the energy demand in terms of the old paradigm. The second point that I'm just going to quickly make is the shale. And Andre, in my position, has been known. He's thinking it's one-time US happening, and I think it can be replicated elsewhere. But the point is that today, at this present time, the US needed to maintain $100 billion investment to stay on the same curve for shale oil. That has been reduced to $60 billion. But what is happening now that they have started shifting to those basins which are much more high-yielding basins. So even with $60 billion investment, they'll still be able to get nearly the same yield from those attractive, selective basins. So I don't think that the present price is going to, in any manner, hamper the growth in the shale oil in the US. The second thing is about this replication. As far as the replication is concerned, I do know that it's very difficult to replicate elsewhere, but the model exists, technology exists. It is a question of economies of scale and brutal minimization of cost. I personally feel I'm very optimistic that you will start seeing this revolution. And Andre, why do they call it revolution? In 2000, just one minute quickly, in 2000, US produced 1.5% shale gas. In 2005, 4.5%. And by the normal law of reckoning, in 2011, they could have produced 10%, they produced 33%. Revolution is taken off, and I think that's another paradigm that you have to take into account in market forces. Thank you, Mr. Chairman, for bearing.
Thank you very much, sir.
Two short questions for Charlie. The first one, economic one. Last year, there was no takers to discuss a scenario where the price of oil was $50. Today, you're talking about $20, and Ed Morse is talking about $19. Where do you think the marginal barrel will be coming from at that price, given the operating costs of a marginal barrel? Who's going to be pushed out? Is it tar sands? Is it shale, etc.? That's question one. That's an economic one. The second one has to do with pipelines. Now, there's a view that the United States is trying to position itself as the guarantor of the flow of oil to world markets, as a strategic card vis-a-vis where China is going to be in 40 years' time. Now, there's 60% of world oil reserves in this area, so America should position itself here. But there's another 10, 15% probably potential oil and gas in Central Asia. What about pipelines coming through Iran, bringing that to the Gulf? I don't think America would like to see it going to market via Russia or China. Actually, it's more economic to bring it this way. So joint ventures in terms of pipelines with Iran to bring the oil to the Gulf, hence strengthening a strategic card, making it the guarantor of the flow of 70%, 75% of world oil reserves to the market. Have you looked into that, or is that out of the box?
Are there any other questions before I turn to the panel? Yeah, one more. I hope you're noting it down, questions.
Thank you. This question is for Charles. Recently in Oil and Gas magazine, it's been announced that Saudi Arabia has selected a very aggressive drilling activities. This is at the time that the United States is reducing its rig count, is reducing the production, and is impacting the oil prices. I am asking the question, has Saudi Arabia has already depleted its massive reservoir, number one, and number two, that Saudi Arabia knows something better than everybody else doesn't know, and number three, what would be the impact of the additional increase in the Saudi production? Thank you.
Who is that question for? Did you actually want the question answered by someone specific?
For you, Charles.
The pressure.
Charles again, eh? Oh, okay.
Yeah.
Charles.
Now you will be responsible for the future of energy.
Okay, Charles and John. And David, sorry. So
I'll just start.
We have 3 minutes before.
I would say I do not believe that Saudi Arabia has maxed out its maximum potential for oil by any way, shape, or form, particularly if you add in the empty quarter and the potential for oil down there. And I'll defer to.
Okay, sorry, I'm going to just interrupt you because one more question was there, and I want to make sure we get the one lady who wants to ask a question, please.
The marginal barrel,
come back to that. Hold it, yeah, please.
Thank you very much. I guess I will be the only woman who's asking a question here. Very honored. So based on my understanding of the panel discussion, it seems very obvious that there's basically two alliances, like one is China, Russia as friends, quote unquote, and the other is the West. They have different views about, the transformations of the roles either in the Middle East, but also in Eurasia and even in the South China Sea area. My question is that simple. Actually, is the situation really that simple? Like, do you think it's oversimplification of, the geopolitical relations as well as energy problems? So do you think there actually should be more like trilateral discussion instead of like, okay, China is in alliance with Russia and, United States and UK or, other countries are different alliance groups. Specifically, like, for instance, for China's case, is the infrastructure development really, definitely in the best interest of China? Like, for instance, in the Silk Road, there's a heavy sand cost for infrastructure, and the cost of importing oil in that route is actually way much more expensive than what we have now through the sea lanes of communication. And plus, that will, increase the vulnerabilities of disruption. On the other hand, China's oil also largely comes from the sea lanes of communication. The Malacca, the Strait, which was largely safeguarded by the sea lanes of communication by the United States, and China does not have the capability to secure its transportation. So if China is developing the maritime sea lanes in collaborations with other organizations, have they think about the vulnerability, and do they have the power to sort of secure the lands, as well as also thinking about the politics or leverage of power, like with the United States as confronting its power as well. And so the relationship with Russia too, like whether...
No, let's, I think the point's
all right,
made.
thank you. Sorry
very much. Okay, Charlie, you want to complete the answer to the first question?
For Usama's question...
Oh, you take all the questions and then we just quickly go around. Okay.
Yep. But on Mr. Jamali's question, I would just say if economics were allowed to prevail, Russian oil would certainly be hurt at these lower prices. I do not believe shale oil will be, because a lot of shale wells are being drilled as we speak and capped because they're not selling. Keep in mind that we are only recovering a very small percentage of the shale that is there, and if we can even raise that by 50% or 100%, we'd still be only going up to about 8% of the reserve in place, and the technology is being developed that will allow us to do that. The U.S. shale oil and gas play is here for a long, long time. We have at least 100 years of natural gas reserves now, and I bet down the road we'll find that that's a much bigger number, and that doesn't even include the Canadian gas if we needed that down too.
Saudi Arabian, is David going to answer that?
I'm happy to offer what limited insight I have, if I'm allowed to. The Saudi Arabia probably doesn't know something that you don't know, but they may know something you've forgotten, which is that prices are sometimes low and prices are sometimes high, and if it's relatively cheap, and it is cheap in relative terms to establish spare capacity, then when prices are low is the time to be doing it, because the cycle is likely to favor you. The problem for most of the rest of the world is they tend to cut back when prices are low so that they are not able to benefit from the market when it swings the other way. So I don't think there's anything, there's no hidden message. They're not drilling aggressively because they've run out of oil, that's for sure.
Andy, well, take up the...
Maybe I will refer to the last question of the nice and charming lady. Of course, ladies are always right. As my wife told me, if she's not right as being a lady and is right to be as a human being. But I have a slightly different vision on this issue, if I may. I don't understand, sorry for saying this, that maybe to consider that Russia and China would like to create an alliance against something, somebody, some others. From my point of view, my personal kind of planning view, it's oversimplification. Again, as I stressed, we are not trying to make alliance against somebody. In this case, economic motivation in my country is just to have more diversity, again, coming back to Mr. Churchill, so Churchill plus philosophy of diversification, I will say it, to have more diversity as a supplier between different markets, in gas between 3 markets, based on this capital-intensive, long-term fixed and mobile infrastructure. Existing key export market, which is European Union. We need to stay there with our market share, and we'll stay there. 25, 30, 33, I don't know. But we will be one of the key suppliers there. Domestic market, which is growing, and in addition to this, emerging, growing Chinese market, Asia-Pacific market, within the emerging Eurasian energy market, based on this skeleton, on this blood system as the infrastructure. So it's not friendship against somebody. It's just, let me say, economic motivation. That is why I'm a multilateral person, not bilateral. That's why I'm working for a multilateral organization. I think in this case, the multilateral common denominator, which means diminishment of investment risks to make an opportunities for all the countries involved to develop infrastructure, either in China, either in the US, either in the Middle Belt, elsewhere. So multilateral international rules that will diminish the costs and risks of investment into the development of the infrastructure, which is a must for me to create the diversified, liquid, competitive global market in gas that will go next to oil. That is a must. So not bilateral, but multilateral approach.
Okay, my final comment, Your Excellency. You've heard everyone, you've heard the panelists. You're the most experienced person on our panel, and with diverse background. What do you make of all of this?
I just want to point out that really the 3 major cataclysms which have happened recently in the first half of this decade are still in play and affecting the geopolitics of energy. The American shale revolution, the ramifications of the Arab Spring, and the collapse of the oil prices. But I want to bring into the discussion, at least for the future, the idea that we are trying to bring together two ideas. One saying that the markets will help us adjusting for everything. The other says we need some sort of adjustment, some sort of management. And with the oil industry, it's a peculiar case where the response to markets takes time and the volatility is increased exponentially, unless we have some sort of cooperation, at least to chop off the extremes of this volatility. I don't think the world can afford going, not utilizing this period, at least in our institutional evolution, to bring a body around which try to coordinate, if not regulate, energy markets. Thank you.
Thank you. Well, thank you very much, everyone. Thank the panelists and thank the audience.